Good afternoon and welcome to today's live LBMA webinar. We are delighted to welcome you to listen to Charlie Morris and Chloé Desmonet as they discuss the impact of supply in gold and Bitcoin. Charlie Morris has been a multi-asset fund manager since 1998. He is the chairman and founder of ByteTree.com, a blockchain and analytics platform, and writes both Britain's oldest newsletter, the Fleet Street Letter, and the periodic gold report, Atlas Pulse. Chloé Desmonet is head of DLT projects at MKS Switzerland, a sourcing, trading and refining company of precious metals in Switzerland. Chloé is also part of the research body of the Blockchain Research Institute in Toronto. Please, as always, if you have any questions throughout the discussion, please feel free to write them into the chat function of the webinar. Charlie and Chloé will try to answer them at the end of their discussion, should there be time. But for now, I shall hand over to Chloé, who will begin by setting the scene for us. So Chloé, whenever you're ready.
Yeah, thank you very much for the introduction and to the LBMA for hosting this discussion. There's been a few eventful weeks in the financial markets in general and the gold market in particular, with multiple unprecedented macro shocks and logistical difficulties to move gold product around as fast as usual. Every investor was reminded that gold is a physical commodity that can be extremely volatile. In gold, we have witnessed gold future and OTC prices disconnect, wide discrepancies in premium depending on the region, and also concerns about mining supply. And in Bitcoin, we are on the eve of the third halving, which is when the reward for mining Bitcoin will diminish. So it's a perfect time to have a look at the gold price driver and compare them to that of Bitcoin. I also think that the current situation proved that there's room for a new gold format, like a gold token, for example, that could alleviate some of the stress in the market, especially on the logistical side. And so with that, Charlie, what are your thoughts on the recent events in the gold markets?
Well, it's been an eventful year, that's for sure. To put it into the bigger picture, I think it's important to remind people that of the major asset classes, and by major I do not include Bitcoin, much that I love Bitcoin, gold is the best performing major asset of the 21st century. And that's a big deal. It's done better than the long bond, it's done better than tips, it's done better than any stock market you care to mention on a total return basis. That's after dividends. So that's you know, quite an achievement. And you know, gold, I think this year has done what it was supposed to do, which is kind of go up a little bit during a crisis. It wasn't supposed, you know, gold doesn't love a crisis to the extent that it's supposed to go to the moon during one, but it's done really well. Now in dollar terms, it did fall in February, sorry, in March, along with everything else, and there was dislocation. And that dislocation is something we become used to in financial markets in certain areas at certain times of stress. And as you say, it's because of the logistics of moving gold around. You know, there are three major gold markets: London, New York, and Shanghai, and they have different weights and measures. You know, for example, in Europe, we use the metric system. In America, they use the imperial system, and they have a different quality of gold in China. And so, you know, when the planes aren't flying, it's unsurprising that you can't settle contracts. But to your point, you know, to put gold on the blockchain really does solve a problem in the long term with this, which I think is quite an interesting discussion point. And also, Bitcoin doesn't have any need to travel around the world because it doesn't really exist in physical form. It's an idea rather than a hard asset. Although, of course, we like to think of it as a hard asset, which in some ways it is because of cryptography. So don't ask me questions about that. Yes, I agree with you. So yeah, I mean, the spreads in the gold market, it's something we tolerate, and they've come back to normal, or they're rapidly becoming back to normal, and the system works, and it's good to see it working once again, despite a little bit of stress.
Yeah, and so as we're in the eve of that third Bitcoin halving, which a lot of people anticipate is going to boost Bitcoin prices, what's your view on the general narrative of the price impact of a long-term reduction in the supply of an asset?
Yeah, and it's a very topical question because the halving is coming on Tuesday. You know, sort of at the moment it's looking like lunchtime on Tuesday. This morning it was looking like 6 a.m. on Tuesday, London time. I mean, who knows? The block times are moving around, so we don't actually know when it's going to happen. But it's sometime on Tuesday. We can say. You know, the point about gold and Bitcoin is they are very, very similar on the supply side, because Bitcoin was designed around the idea of gold. So we know that there are, roughly speaking, 200,000 tons of gold held above ground, and there are 18.5 million approximately Bitcoins. And the moment the Bitcoin supply grows at 4% a year, from Tuesday it will be 2% a year, and in 4 years' time it will be 1% a year. Now, you know, about 3,000 tons comes to the gold market each year, means that the global gold supply rises by about 1% a year. So, you know, looking forward, both of them are 1% growth assets in supply, and I think to me it's a very obvious point. But if the amount of gold was growing 30 or 40% a year, and the amount of Bitcoin was growing at 34% a year, we wouldn't be talking about them. We wouldn't be having this conversation. You know, there'd just be, you know, not very interesting assets that no one had much confidence in. But the fact that both of them have supply and pretty much guaranteed long-term low supply means they're interesting, means they're scarce. And it's why they're credible. But it's other factors, and now they're credible, that gets them into the room. But that's not the part that creates value. And I would look at other asset classes, for example. You know, I'm talking to Geneva, Chloé's from Geneva. The Swiss franc, a great currency, as is the Japanese yen, a great currency. But we don't buy them to appreciate because they've got low inflation. We buy them for stability. So I think low supply just gives you stability, and it gives you a license to turn up and call yourself a high quality asset. And it's as simple as that. The demand side of the equation is the other side of the equation in any asset, and that's how we price things. In gold, we've learned that it's all about, you know, there's flows are important, but actually it's real interest rates seem to be the most important medium-term driver, the most important long-term driver being inflation itself, the value of fiat money, which of course always goes down, so gold always goes up over the long term. But in the medium term, we've got real interest rates to hang our hat on. And then there are short-term speculative factors. You know, in Bitcoin, I see the demand side as the usefulness of Bitcoin, the size of the network effect, its utility, the need to hold it, and that sort of thing. And we can come back to that. But I think that's so to conclude, I don't think that halving's a price appreciative event. And in the gold market, no one gets excited when the miners down tools and stop supplying the market with gold. No one thinks the gold price is going up when the miners stop mining. It's not even a factor. It's not even discussed. So why it's such a big deal in Bitcoin, I don't know.
Maybe it's because it's just not a market that's as mature as gold. I mean, I think gold's intrinsic value also come from its long history as an effective store of value, and just Bitcoin doesn't have that yet. But in terms of intrinsic value, I think it's important there to look at the fact that Bitcoin's intrinsic value comes from the fact that it's being used. And so that's the network effect that you were mentioning. And that's really important in your outlook, right?
Absolutely. And I mean, I can give some examples of that. You know, my view is that if you sort of think about the world of fiat currencies, the dollar is clearly the king, but the dollar is more valuable if all the other currencies that report to it, from the pound to the Swiss franc to the peso, doesn't really matter which one it is. If they're all doing well, then actually that makes the dollar in some ways worth more because it represents a greater economy. And I think in the same way, Bitcoin represents the economy beneath it. So all the other things happening in the space, some of which, you know, if you're going back to the 2013 altcoin boom, was clearly speculative only. But I think as we go forward into the next 10 years, we're going to understand why we need it. I'll just give the example of the Brave browser, which you get paid in crypto to use it rather than Google receiving ads, the ad revenue. You know, you receive some of the ad revenue yourself. And that's a very powerful concept. And if all these big, powerful internet models are slowly attacked by crypto over time, then, you know, there's a 100% chance that this space is going to be a hell of a lot more valuable in 10 years from now. So I think the value in Bitcoin is entirely linked to the usefulness in the space and the, you know, the geniuses writing good software and monetizing the internet, and really nothing to do with spooky supply stories.
Interesting. Well, staying on some of the interesting innovation, do you see that some of the recent innovation, like the various types of gold token that we're seeing more and more frequently in the market, that are putting physical gold on the blockchain, do you see that as you know, potential to ease the circulation of gold and alleviate some of the logistics bottleneck, and in time maybe having an effect on the overall gold liquidity and maybe the price?
Yeah, I think. Well, the biggest innovation in the gold market in the last, well, this century has been the ETF. It's been a very powerful tool. And I think the last time I checked, it was about $150 billion, or it must be more than that by now, of gold is now held by ETFs. And it solved a simple problem. The legal problem is, how do you put a bar of gold that's physical into the financial system and represent it through custody and so forth. And I think the token is a very powerful tool. And as you say, and Chloé, I know you represent DGLD, but without wanting to promote that or discuss that in detail, the concept of gold tokens, and there are plenty of them, are very powerful. And gold is the ideal vehicle to test tokenization for, because it doesn't pay a yield, and don't give me lease rates. It doesn't pay a yield, and it's just simple. And as you say, you can store it in one place, and you can send the token around the world as you like, and that really is a neat solution. And I suppose once gold proves that works, then many other assets will follow, starting with the liquid ones, ending up with illiquid ones. Ironically, there's a lot of people trying to do property in tokenization. I find to start with the illiquid is probably the wrong way to start. I would start with liquid and go to illiquid later. But hey ho.
Yeah, I mean, like you said, I think, I mean, obviously, because of what we're doing, we're very much behind putting gold on the blockchain, but it's true. There's upwards of 50 different token projects at the moment, a gold token, a precious metals token, sometimes basket tokens. They're at various stage of development. There are really 3 that are dominating the market at the moment. Just to even the playing field a little bit, I think eating up about 95% of the market value at the moment is Pax Gold, Tether Gold, and RDGLD. But there's many more. Significant difference exists between the different tokens, and that go from the measurement in the peg to gold, the cost of owning and using your token. There's also the blockchain platform choice. There is the location of the actual underlying gold that is backing the token, and there is also differences in the option to redeem or exit your token in physical gold, so go back to the actual gold bar, and that is very different across the board. So when you consider looking at token, you need to do a little bit of homework. In my view, there's still a few criteria that are absolutely paramount if you're considering an investment in a token. Say the first one being the technical infrastructure. So what chain is it functioning on? You want a robust ledger. Then it's the legal and regulatory framework. Has the regulator given an opinion? Is there direct ownership of the underlying? Because that's really important. Then there's transparency. Is there a gold underneath? Can I assess that myself? Is there an audit sort of stuff? And then I'd say last but not least, because a gold token is nothing but the representation of ownership of the underlying gold. You want the underlying to be managed professionally. So you need the people that are behind the gold token to be, precious metals professional. And that's super.
I'd say, I mean, you mentioned quite a few things, and I suppose the big idea there is that a gold token is a private blockchain, so it's not about the mining, it's not about it's a good old-fashioned trust, and also you've got a KYC trail, haven't you? So the money laundering regulation is taken care of. How does that work?
So again, that will depend very much on the type of tokens. What we've seen and what has been interesting is the second layer technology, where you're using a public blockchain that is highly transparent, that is super robust, as a base layer for your infrastructure, so you can audit it very easily, and then you superimpose on that a second layer, which is a private permission blockchain which you control, and at that layer you can impose KYC, AML, ID checks on your users. And so every now and again, on a regular basis, your private blockchain is going to peg on the public one, and it's going to verify all the previous transactions that have happened, and that's sort of the best of both worlds. And that allows you to both be, have public record that anyone can actually go and look at, and at the same time to implement very strong ID check and AML features.
Yeah, I know this is important because the regulator demands it, and I think a lot of people in the crypto space and in the gold space kind of think they can live outside the system, but actually, if you need technological solutions, you can't. You've got to let the regulators have their say. And it does seem to me that some of these gold tokens are doing a good job, and I can't speak for all of them, but it's a space where there probably doesn't need to be 50 of them. There'll be a few neat survivors, just like the ETF market. iShares dominate, and Vanguard's doing well, and that's fine. And so I can see it just being a sort of replication of that. And I guess scale is really important. The bigger your token is, the better it works. The lower the less you can charge. And all these sorts of things. So yeah, I guess it's a winner takes all world, and transparency and credibility and trust and honesty will be absolutely vital. But what about liquidity? I mean, if I know the underlying gold market's really liquid, but what about tokens, the gold tokens? Can you move large sums in a short space of time?
Yeah, I mean, you should be able to. There's no problem. I mean, in terms of again, depends on the peg of each tokens, but if they're pegged on the actual underlying, which most of the time, at least for us, is LBMA large bars. So the price of the token is equal to the spot price of gold, and no matter what exchange it trades on, it should be that. And if it's not, that there's arbitrage opportunity for people to actually push it back to where it's supposed to be. Because if the prices sort of disconnect, you could actually buy tokens, sell the gold, or do the reverse.
And which market do you reference from? London, New York, or probably not Shanghai?
London.
London. Okay. So it's traditional physical ownership rather than reference to futures and so on.
Yeah.
Yeah. I also think that certainly within the crypto space, it's funny how the Tether dollar has become and the Pax dollar has become so powerful. You'd kind of think that the gold would be a better stable coin for most people than a fiat currency, since the sort of joke of the whole space is to get away from fiat currency in both gold and Bitcoin. So and I was going to finish off that point is, people in Bitcoin who think gold's the enemy and they're trying to take its role. It's just not the point. They're both sort of assets which have got credibility and exist to some extent outside the system and can thrive outside the system because they're independent of it, which is a good thing. But then their reference point, as I said earlier, gold is an inflation hedge. I mean, so is Bitcoin, of course, if you're in Venezuela, but not at the moment. If it's volatile if you're in Switzerland, or if you're in the US or Britain or Japan or somewhere like that. But that volatility obviously goes away in hyperinflation. But the reference points of how to value them are completely different. One's risk on, one's risk off. We've seen it in this recent COVID crisis. Bitcoin collapsed along with internet stocks. Gold didn't. Well, it did have a small fall because of the dislocation, but basically it fell far less than the market in general, and it was the first asset to recover. So that's what you expect from a high quality asset like gold, just like stocks like Nestle and Procter and Gamble. That's you put them into that bracket of the really, really good stuff. And whereas Bitcoin is in the bracket with stuff like Tesla, and we love Tesla obviously, but it behaves more like that than it does like a gold bar.
Absolutely. I'm agreed. I think we're right on time, maybe, to either wrap up or give the mic back to LBMA.
Yes, thanks guys for that great discussion. We actually do have a few questions, so I'll start with them now. But before I do, just to let everybody know, just if you do have questions, please put them in the chat function. So starting with our first question, we have, what type of blockchain would support tokenized gold? We see some examples where folks are using ERC20 tokens, but these do not necessarily convey information regarding the bar specifications with them. For example, bar, serial number, manufacturer, etc. Also, in a blockchain world, in a similar global scenario, we would still need physical settlement. How would blockchain solve this?
I'll take the at least the first half of that. The different blockchain technology that are used for gold token. Out of the 50 or so gold token projects that are out there, I'd say like the vast majority are going to be ERC20 token, just because they're extremely easy to use and move around. Like there are a few that have departed from this, especially ours, for example, where we've chosen to use the Bitcoin network because we thought it was more robust and resilient, and also because it was allowing us to sort of encapsulate ID checking at the protocol layer, and that was important to us. But like I said, the different token will vary a lot in their features, and usually the choice of technology respond to the different feature that they chose to display.
My answer to that question would be on the technology side, ask someone else. On the sort of financial side, gold, the amount of gold held by ETFs as at now is $164 billion. The market cap of, or the network value, as I prefer to call it, of Bitcoin is $156 billion. So there's more gold in ETFs than there are valid Bitcoins today. And don't forget, quite a lot of those have been lost or non-distributed. So that number is actually more like $100 billion. So I just think what we're doing here is replicating the ETF model. So all your questions about, bar numbers and custody and so on, whatever works for the ETF market will work here. And in most cases in the ETF market, it's allocated gold, and so it belongs to the ETF. It's not lent out by the bank. I know no one believes that, but it's true.
Okay, great. Thanks, guys. Moving on to the next question. Isn't crypto gold the enemy of Bitcoin? Bitcoin used as currency is dropping while fiat cryptocurrencies and crypto gold is skyrocketing. Will fiat stablecoins issued by central banks kill Bitcoin?
Okay. I mean, I take the beginning of that question. I don't think gold token are the enemy of Bitcoin at all. I think it's a good use case of the technology. It shows that you can put a mature hard asset on the blockchain and it works, and you can use it as a payment token, as a means of payment, and that's really important. You will find a lot of people, not necessarily like Bitcoin advocates, that will tell you that the problem with Bitcoin is that it's extremely volatile, and besides its use, it doesn't really have an intrinsic value, something to anchor it. And I think somehow a gold token is an answer to that. Like you want a stable coin that is anchored to a mature real world hard asset that's proven its value as a store of value for decades, then you have a gold token. And I don't think the two really necessarily compete.
I don't see them as enemies at all. I just think that the crypto space, and that's Bitcoin Plus, is growing very, very rapidly, and it's got many, many use cases. And one of them is to host gold. And what's wrong with that? And the idea that someone buys gold on the blockchain is going to put the price of Bitcoin down. No, it's the other way around. I think the more use cases there are, the more Bitcoin is worth, as because it sits at the top of the food chain. As I said, it's a bit like the dollar and all the other currencies. If all the other countries are doing well, then essentially an alien would come down and prefer to buy dollars than if America was the only country doing well. And I think that's the case here. A healthy crypto space is reflected by a higher Bitcoin price. And if some of the junior things want to outperform, well, great, good luck to them.
Great. We have another question. Central banks have put a cross on Bitcoin, but are working on their own fiat cryptocurrency or a SDR cryptocurrency. Bitcoin is nothing while crypto gold is backed by gold.
I think that's just a stable coin. If the central banks like China or whatever want to issue their own blockchain technology, again, it validates a space. It's another use case. Thank you very much. Well done. It's another reason to buy Bitcoin. It's just proving that the technology is brilliant. And in the case of China, they just want to bypass the formal financial system in some way and have a bit more control over their own affairs. You can understand it from their perspective. And I think more countries will do that, and more things will happen in this space, and that's great. It's not a threat. It's just a stable coin.
Yeah, I mean, and there are lots and lots of stablecoin, and you know, we're seeing a lot about article about central bank digital currency, and you know, I absolutely welcome all of these initiatives. I think you know, what's going to be interesting is finding a payment network that is going to allow all these different stable coins to circulate. That's really going to be an interesting development. But yeah, I don't think they necessarily compete or they cancel each other off.
I think, you know, just to finish off on that point, you know, I go back to what I said about the gold ETF being a fantastic innovation, because it's a really simple point, but it's an important point. You know, how the hell do you put a piece of gold, and I've got one here. It's not real, it's a door. But how do you put that inside a portfolio? What do? You shove it somewhere? I don't know what you do. So you wrap it you put it in a vault, and you have an auditor, and then you have a system of trust, and then you have a custodian, and he sends an electronic signal to your portfolio and says, I've got some money and some gold. Yeah. And so if you can solve that problem in crypto, and by the way, if currencies come through and SDRs come through, brilliant, because then the traditional custodians that represent the trillions of dollars of assets must have a solution to start working with the space. And I think that would be a positive for the space, because I think that the space would be much bigger if the banks hadn't gotten its way. You know, if it was easier to transact from fiat to Bitcoin and backwards than it currently is, then the space would be much bigger. So the fact that the space is this big in 10, 11 years, despite the obstacles put in the way, is very impressive. It just shows you that it's unleashed. It's a bit like gold in 1970. Just watch this space.
Great, thank you. For our next question, we have, what is the business model of privately permissioned blockchain?
That's for me. I'll answer for our specific project. The way it works is we don't invoice people for the use of blockchain. There is just an administration fee that is taken through an inflation mechanism on your token, which means that randomly every 8 hours, the token that you hold is going to represent a little bit less of the gold that is in the stored with us. And over the year, all of this little inflation mechanism is going to amount to a rate of an admin fee. And that comes to remunerate everything that we need to do in order to maintain this token. So that is the IT infrastructure, that's the storage of the gold, that is all the maintenance and upgrade of the code, and that's it.
And Chloé, can I just say, I don't think we have to apologize for creating great things in the space, whether it's a data website or a gold solution. I think we're allowed to make money, and we're allowed to charge for things. And,
I don't know. I mean, we have to charge anyway, but yes, we are charging.
We have to charge.
But every single gold format out there is you know, comes with a price tag, either direct or indirectly.
Great. I think we've got time for one last question. So given the size of money pumped in, assuming a 2008 to 2011 type rally, where can gold reach on the upside?
Should I take that one, given the notion that was published in the LBMA's Alchemist magazine, and it reflects the presentation I gave to Denver Gold, which you'll find somewhere online. And the gold target I have is $7,000 for 2030. And by the way, Bitcoin outperforms gold. That goes without saying. So why? It's because we're at a 20% premium to fair value. Fair value is around $1,400 in my opinion. This is gold, not Bitcoin, to be pleased to know. And that will probably go to about $3,500, assuming the long-term expected rate of inflation goes to 4% from the current, it's currently just above 1% in US dollar terms. And if that goes to about 4%, which will be the result. We have deflation now, and we have inflation later once the economy recovers, and that could take a couple of years, 2 or 3 years perhaps. But once we get there, then inflationary pressures will start to build. And assuming they can get to 4%, then that puts a fair value of about $3,500 onto the gold price. Now, if you have by 2030 10 years of inflation of 4%, then that's another 50%. So take your $3,500, add another 50%, and then the premium goes from the current 20% to 50%, which is what it was in 2011 at the top of the bull market. And you have a very simple case for $7,000 gold just on the idea of reflation on the other side of this crisis.
Great. Well, thank you so much, Charlie and Chloe, for your time and your wonderfully informative discussion. If anyone has any questions that we were unable to answer this afternoon, I can see that there were a few remaining. We will be sending out an email of the recording as usual with details of who to send your questions through to, so please don't hesitate to contact us. Once again, we thank you for your time, and on behalf of everyone at LBMA, I hope you stay safe, healthy, and have a lovely long weekend.
Thank you.
Thank you.
Pleasure.
Thank you.
Bye.
Thank you, Chloe.
Bye-bye. Take care.